Kavanaugh. Like to welcome you, Lizette. Wish you all the best and any assistance we can give. That's why we're here. And with that,
All right, this is the New York City Fire Investment Meeting. We are at 1 Battery Park Plaza, 9th floor conference room. We have some attendees participating via Zoom. Today is March 23rd, 2023. It is 9:51 a.m. Mr. Dunn, would you please start the roll call?
certainly for Mayor Adams,
Adams.
Brian Berg is here representing Mayor Adams. For Controller Lander,
Allison Hirsch representing Controller Lander.
And John Dorset as the alternate.
morning. And for Commissioner Nyblack, Finance.
Kevin Dew.
Okay, and for the UFA, for Mr. Andy Ansbro,
Bobby Andy Answer's proxy.
Mr. Eustace,
Present.
Mr. Edward Brown,
Here.
Mr. Eric Bischoff,
Present.
and Mr. Peter DeVita. Sorry, John, I didn't see you here. Okay, and for the UFOA, Chris Jensen,
Present.
Mr. Guilfoyle.
Here.
And Mr. Brosey. And for Fire Commissioner Kavanaugh,
Lizette Christoph.
we have a quorum.
All right, we will start with the public agenda. I will turn it over to the Controller's Office.
Great, thank you, Commissioner. So before we start today's meeting, we want to just give you a brief update on the quarterly report. So Steve Meyer is joining us. I want to note Steve's on vacation, or else he would be joining us in the room today, but he is taking time out of his well-deserved annual leave to address the board this morning. So Steve, we'll turn it over to you. And I think that we've already been informed there may be one or two questions from some of the trustees regarding the quarterly report. So Steve, with that, I'll turn it over to you.
Sounds good. Thank you, John. And good morning, trustees. I'm sorry again, I'm not there in person. And I understand also there may be a time constraint. So I'm going to try to move quickly through my remarks. And again, happy to answer any questions at any point. So just interrupt if that's appropriate. Maybe just as a recap of last year, 2022 was a very challenging year for the U.S. economy and for financial markets. Just to remember, we had a slow economic growth. We had the first and second quarters actually generating negative GDP growth. We had June inflation peak with CPI at 9.1%. We saw substantial declines, painful declines in prices of both stocks and bonds in tandem, which is actually not unusual, or is unusual but not unprecedented. We had elevated geopolitical risks associated with Russia's invasion of the Ukraine. We had a challenging, changing dynamic between the United States and China, which is ongoing. And we had the most aggressive Fed rate hikes in 40 years. Unfortunately, 2023 is shaping up to be another challenging year for both the U.S. and global economies and financial markets as a result. Let's take a quick look at conditions past and present and hopefully give you some insights into what we think is coming down the pike. Also, a hats off and a thank you to my teammates within the Bureau of Asset Management. We did revise the slides given all the recent developments in the financial markets, particularly in the banking sector. But everything we put together in the last couple of days is even a little bit stale, so I'll make adjustments as we go along. On the first page, Kate, the story for 2022-23 has been a focus on high inflation both here and abroad. We've seen elevated levels of inflation in the U.S. Early in the first quarter. Chair Powell did, however, reflect that the disinflation process has started. We are off the highs. We had a high, as I mentioned, in June of 2022 of CPI inflation of 9.1%, and it's moved down to just 6%, still very high relative to the 2% inflation target at the Fed. The service sector is also a source of significant increases in U.S. inflation and pushing rates higher. We had the February CPI, as I mentioned, down 6% from 6.4% change year over year. We have had one change, though, on the global front, where the UK's inflation actually moved up from 10.1% to 10.4%. And that also precipitated a Bank of England interest rate hike this morning of just 25 basis points. On the next slide, a look at inflation domestically. U.S. inflation is again well off of its peak of 9.1%, but still sticky at 6%. And you've got the core personal consumption expenditure deflation deflator at just under 5%, which is still a challenge for the Fed. On the next slide, just an evidence of that. Again, the inflation over the year-over-year, 3-month and 6-month change, you can see it's sticky around 5%, and that will cause the Fed to continue to focus on inflation. But there are many other factors at play now in the markets as well. On the next slide, you can see inflation around the world has kind of moved lower off of its peaks of 2022. The exception being we had a little bit of an uptick again in the UK, moving up 0.3% to 10.4%. But other than that, you can see that the peak in inflation is largely behind us, and expectations are that we'll continue to make progress given central bank policies around the world. On the next slide, the inflation drivers here and abroad, or here and really in Europe, are quite different. On the left-hand side of the screen, you can see the U.S. inflation drivers, really driven more by the light blue line, which is services, relative to food and energy, and the dark blue lines. On the right-hand side in Europe, you can see that it's really driven more by food and energy, with an emphasis on energy and the impact of Russia's invasion of Ukraine and a diminished supply of Russian oil and gas in Europe, putting upward pressure on energy prices there. On the next slide, again, inflation drivers, and you can look and see goods in green and services in blue. Goods inflation has actually moved down quite nicely to around 2%, whereas services inflation in the U.S. is pushed higher. A lot of that has to do with wage price pressures associated with a vibrant services sector and the demand for experiences and activities. On the next slide, consumers expect lower inflation in 1 year, but you can see that they moved from 3.9% expectation over the next 12 months up to 4.1%. Again, that would suggest to me that some level of inflation is getting embedded into people's psyche. That it will be a problem for the Fed over time. So again, inflation has been proven to be sticky on the upside. On the next slide, U.S. employment is still very, very strong this year. We had a monster payroll report in January, creating 517,000 jobs in the economy. Unemployment in January hit a 53-year low of just 3.4%. And the Fed's non-farm payroll report for February beat estimates of around 240,000 jobs created, coming in at 311,000 jobs. So the jobs market is still strong. And this is a problem for the Fed if it persists, because again, it increases wage price pressures, which is a significant factor in pushing up inflation, particularly in services. On the next slide, just another look at that. The yellow line on the far right-hand side, that actually indicates the participation rate of employment in the United States. It still hasn't recovered to pre-pandemic levels of around 63. It's coming in at 62.5. And you can see the white line on the lower right-hand side at 3.6%. That's the current unemployment rate. On the next slide, inflation in the U.S. is really driven by services. And you can see on the far right-hand side of that screen, this is the January numbers, but here we had health services, professional and business services, and leisure and hospitality services really driving employment much higher. And again, with a lagged effect on inflation. On the next slide, we basically have 11 million more job openings than we have candidates to fill them in the United States. And you can see that on the far right-hand side. And that's a problem. We've got a structural imbalance of labor in our markets that may be driven by various things, again, coming out of the pandemic, but some longer-term trends such as demographic trends, baby boomers retiring, immigration policies, as well as low birth rates in the States. It's creating a longer-term shortage and a more of a structural shortage over time of labor in the United States. On the next slide, a look at US and non-US economic growth. US fourth quarter GDP was revised down to 2.7% from 2.9%. But economic activity for the early part of the year, all indicators in the first quarter of 2023 have actually come in stronger than expected. So the economy seems to have been going quite well. We recently hit some speed bumps, which I'll talk about in a moment, that may slow things down in addition to the Fed rate hikes. Again, recent banking sector disruptions will likely reduce access to credit in the economy and slow economic growth over time. That was actually confirmed by Chair Powell yesterday at the Fed meeting, where the Fed raised rates another 25 basis points, largely in line with expectations. From a global growth perspective, though, we also have China's reopening following the pandemic. And this will be a positive factor in terms of creating more growth in the world economy. Their expectation, their target for growth in 2023 is 5%. I think the global markets thought it would come in closer to 6%, so it was a little disappointing, but still will help global economic growth. And on the following slide, just another representation of that. You can see that we're returning to some level of normalcy after a tumultuous few years associated with the pandemic, where really growth was all over the place, but it's come back to about where it was. The exception there, I'd say, is China coming in again at just 5% versus 7.8% on average over the last 10 years. Consumer sentiment, maybe skip the next slide. I think that a lot of the challenges we've seen in the banking sector and the incredible amounts of volatility in yields and rates kind of negate some of these slides at this point. This slide, however, is a look at professional forecasts for a recession in the United States. It is the most anticipated recession ever. And you can look at this long-term chart, where at the time of this print suggested that professional forecaster was looking for about a 45% chance of a recession in the US in the next 12 months. I believe that a recession is probably more likely, particularly given the disruptions we've seen in the banking sectors. On the next slide, a look at economic growth here and abroad. Again, the expectations for recessions are still very high. The one exception, I'll start with that, is the lower dark blue line on the far right-hand side. That's China with a very low probability of recession, particularly given the fact that they're coming out of a pandemic and there's a lot of pent-up demand for activities and services. Farther up in that, you can see there's about a 90% chance of a recession in the UK. Again, the Bank of England continues to raise rates out of necessity, given the high levels of inflation, and it's still over 10%. And in the US and European Union, still 60 to 70% probabilities of a recession within the next 12 months. So again, high expectations there, given the need to slow the economies and combat inflation, which has been stickier than a lot of people expected. On the next slide, I'll look at US and global interest rates. As I mentioned earlier, yesterday, the Fed raised rates 25 basis points to a 4.75 to 5% range. The Fed Chair Powell also reflected that some additional policy firming may be required. The ECB actually raised rates 50 basis points last week to combat inflation in that economy. As I mentioned, the Bank of England raised rates 25 basis points this morning. Powell also remarked yesterday, however, that tighter credit conditions can substitute for rate hikes. So expectations were that there were probably a few more rate hikes coming. We had one yesterday. I think the market's pricing in perhaps another 25 basis point rate hike to get to near the terminal rate of Fed funds of 5.1%, which is unchanged from December. But the market is also pricing in an expectation that the Fed will cut rates later this year. And I think that is inconsistent with recent Fed communication, but also recognizing that we've had some real disruptions in the US and global banking system with the receivership of the Silicon Valley Bank, as well as Signature Bank here, and the forced takeover of Credit Suisse by UBS in Switzerland, which is a GSIB here, a government systemically important a global, systemically important financial institution. On the next slide, let's skip this. This is just a look at rates moving higher. Here you can see the magnitude of the rate hikes in red over the past a little over 12 months now. And this doesn't reflect the rate hike we saw yesterday from the Fed. But again, it's one of the fastest rate hiking cycles in over 40 years. As I've said, I think pretty consistently, anytime the Fed has moved this quickly, it tends to create disruption in the market. Something ultimately breaks. We saw a little bit of that last year in crypto and a couple of leveraged players. And now we're seeing it in aspects, very concentrated aspects of our banking sector here in the States. And we're seeing that abroad as well. Let's skip the next slide, Kate. As financial conditions are tighter in Europe. Here we've got U.S. credit spreads and U.S. Treasury yields. Yields have been all over the place. They started 10-year Treasury started the year at 3.88, went down to 3.30s, went back up to close to 4%, and then are back down around 3.5% today. So a lot of volatility in 10-year Treasuries, and that's not just here; that's also abroad. We saw a particularly strong rally in the 2-year U.S. Treasury notes recently, where yields declined from a little over 5% down to less than 4%. Which is where it is today at the 3.97. We saw the inversion of the yield curve go from about 110 basis points, meaning the 2-year yields were above 10-year yields quite substantially, to just 47 basis points this morning. So again, a lot of volatility in the markets. There's a lot to think about, and it's hard to kind of look through the noise and pick out the signals to see where we're really going to wind up, where the Fed's going throughout this process. And the impact on financial assets, most importantly. So the last point on this slide is we've also seen a fairly dramatic increase in credit spreads in investment grade and high yield. High yield spreads have actually moved up a little over 100 basis points over the last 2 weeks, and investment grade credits, which are more banks and other higher credit quality creditors, have also moved up and wider, about 40 basis points. On the next slide, this is a slide that typically reflect to show the yield curve and expectations for rates. The most recent addition here is in red, and you can see that's below where it was at the end of last year, meaning that longer term rates have moved down while short term rates have remained sticky on the upside, again reflecting that inversion. On the far right hand side, you can see that inversion that we talked about. It peaked at about 110 basis points earlier, within the last month, and it is now just about, I'm looking on the screen, about 47 basis points this morning. On the next slide, as I mentioned, there's extreme levels of volatility in 2-year and 10-year Treasury notes. Here you can see that at the time of this writing, the 2 years were at 4.16 and 10 years were at 3.58, but they've been all over the map. 2 years this morning are under 4%. And 10s are under 3.5%. So a lot of volatility there this year. On the next slide, as I mentioned, credit spreads have widened out. We updated this slide. I'd given this presentation about 2.5 weeks ago. And at that time, the orange line, which is high yield spreads, were about 397 basis points over comparable treasuries. They're now 511 basis points over treasuries, again, widening out to reflect an increased concern about credit exposure. And the investment grade, that white line on the bottom, about 2.5 weeks ago was 110 basis points. Now it's 1.63 basis points, or 163 basis points above comparable U.S. Treasury yields. On the next slide, the dollar is also weakened this year. Next slide, Kate. The dollar is weakened this year. We've seen that against developed market currencies as well as emerging market currencies. We did see it bounce around quite a bit, however, with the challenges in the banking sector, with a flight to quality bid into U.S. Dollar-denominated obligations. That's come off and weakened. We've also seen with other central banks continuing to raise rates and the expectation for more rates to come, that interest rate differential advantage the U.S. had is somewhat diminished now that other central banks and rates have moved higher. On the next slide, just a look at where we are recently. So relative to the euro, If you remember, towards the second half of last year, 2022, each euro bought only 93 cents in the dollar. Now it buys $1.06. The pound sterling at one point was buying just $1.03 and is now buying over $1.21. It's actually over $1.23 today with the recent rate hike we had this morning. And the US dollar was purchasing at one point a little over 150 yen, and it's now purchasing just about 133 yen. So slightly weaker, and that's reflective again of that those interest rate differential changes and concerns about our banking sector here in the US. On the next slide, a look at US stock and bond returns. As I said, 2022 was a very challenging year. 2023 is certainly shaping up to be very volatile as well. We haven't seen volatility in the bond markets for a prolonged period to this extent in quite some time. Although if you look at our global stock holdings, they tend to be up still single digits year to date. And the NASDAQ is actually up quite considerably with the reduction in rates and the impact of discounting forward earnings. At that lower discount rate increases the price of tech stocks, which is reflected in the NASDAQ performance year to date. On the next slide, a look at the sovereign 10-year yields. They've had a very dramatic move higher. At one point, US Treasury yields were over 270 basis points above where they were a year ago. That's now only 140 basis points given the recent significant rally. But if you look down the line, you can see that in every developed market on the far right-hand side, the 1-year change in 10-year sovereign yields are all positive and substantially so. Again, and that will create a condition where credit becomes more expensive and perhaps less available given the disruptions in the banking sector. And that will ultimately slow the economy over time. In terms of market volatility on the next slide, on the left-hand side, you can see the VIX indicator, which has actually been fairly sticky on the downside. It's only 21 today. On average, over the last 30 years, it's been about 19. So it really hasn't shown an elevated level that I would have expected. And typically above that green bar in the middle, above that is risk off. And below that is risk on. And again, at lower levels of volatility, you tend to be inclined to take more risk. On the right-hand side, however, that is the MOVE index, and that's an index that reflects the volatility in bond prices. And if you look at the far right-hand side of the screen, you can see the sustained and substantial volatility in US Treasury yields and implied yields associated with options pricing. And on the very, very far right, you can see there's a spike. That's the recent volatility we've seen over the last week, which is, again, noteworthy. Next slide, just a look at the increase in volatility in bonds in green relative to the VIX or equities in blue. And again, you can see that for a prolonged period of time now, as the Fed's gone through its rate hiking cycle and concerns have developed in the banking sector, that volatility in fixed income and US Treasury debt in particular has been very high. On the next slide, a look at market returns. On the left-hand side, you can see the equity returns for US, ex-US developed and emerging markets. They've all turned from their lows that we've experienced in the second half of 2022. They've had a fairly decent, or we're having, I should say, a very decent rally early on in 2023, which they've given some of that back again, given the recent disruptions in the marketplace. On the right-hand side, you can see that the Barclays, should say the Bloomberg US Ag annualized returns were significantly down last year at near 18%. Certainly the Ag has come back from that with the rally in rates. And we'll see how that actually works out as we over time, as we take a look at credit spread widening and again, where we wind up with yields. On the next slide, actually, why don't we skip the next slide? This is just a look at the 60-40 reference rate. And as I indicated, I've touched on more recently, we've had some significant news in regional bank sectors. I believe that these are, well, they have the potential of becoming more systemic from a deposit insurance basis. But I think the two issues that we have with Silicon Valley Bank and Signature Bank had more to do with concentrated business lines and very, very high levels of uninsured deposits, which have proven to be less stable than would have been expected. And these institutions have been put into receivership and are going through a process of sale or liquidation. As I mentioned earlier, we also had, which is really quite remarkable and noteworthy, the forced acquisition of Credit Suisse by UBS, put in place by the Swiss banking regulators. Credit Suisse has been an organization that has been around for over 160 years. And over the last 15 years, they've had great difficulty from a business model standpoint. It seems that any negative event that's hit the press is somehow touched Credit Suisse. And a loss of confidence in the bank of that size and the dramatic, tens and hundreds of $billions worth of deposit outflows created a situation where they had to be shored up and ultimately combined with UBS. So disruption in the marketplace, excuse me, a lot of volatility and a lot of continued uncertainty going into the rest of the year. Maybe two more slides, and then I'll get to the performance through the end of the fourth quarter. Food for thought on the next slide. This is just a reflection, and it's actually an overlay of the 1970s and 1980s relative to where we are today from a U.S. inflation standpoint. And I think the takeaway here is the fact that once inflation peaks and starts to come down, it oftentimes takes up to 2 years for inflation to come back to where the Fed would like it, or to more normal levels. And earlier on, notwithstanding the recent disruptions we've seen in the banking sectors, I would have been inclined to say this will be the case and the Fed will be higher for longer. But I do think that things are a lot less clear, more uncertain. But I do think that inflation will prove stickier on the upside and perhaps take a lot longer than the market is currently priced in terms of combating that inflation. And on the next slide, the last slide, just food for thought. This is the way everyone looks at the turning point for the Fed. When they pause, typically within 12 months of them ceasing their last rate hike, the S&P 500 rallies 15%. And that's what this slide shows you. So everyone keeps talking about the pause, the pivot. And this is why this is a focus, because there's a hope and expectation that we'll see something similar to this this time around in a rally in equity prices. And with that, let's take a look at performance for the fourth quarter, and more specifically performance for the fire pension plan. On the next slide, Kate, this is a look at public market returns through the fourth quarter. There's a lot of black in that middle fourth quarter line. You can see that we've actually had, or column, I should say, we had a nice recovery in public market obligations in the fourth quarter, notwithstanding the fact that it was a painful year overall, which is obviously it sticks out that red column towards the right-hand side of the page. But again, public market returns were strong across both equities and fixed income in the fourth quarter. On the next slide, a look at FIRE's net public market returns, a net of fees by strategy. And again, you can see here it's all black in the last 3 months of calendar year 2022, and strong performance across the board, reflecting that rebound. I think it's also important to note and important to focus on the longer term outcomes. And on the far right-hand side of the slide, you can see in 5 years, it's almost all, with the exception of emerging markets that have had some challenges coming through the global financial crisis that have been residual. It's been strong across all, or positive, I should say, across all asset sectors. On the next slide, a look at FIRE's net private manager returns by strategy. Here, it's actually a much better story. If you look in 1 year, you can see with a slight negative return associated with hedge funds of just 20 basis points negative return. It's been positive across the board for private equity, core and non-core real estate, infrastructure, and opportunistic fixed income has been in the black, but less than 1% up. And again, here I think it's very important to focus on longer term outcomes. If you look at the 10-year sector, it's been very significant return stream associated with these investments over time. On the bottom of the slide, you can see the actual fire's total plan performance, which includes private assets relative to your policy return benchmark. So you've come in the last 3 months of the year, plus 4.9% relative to the policy returns of just 4.6%. You've outperformed your policy benchmark by 30 basis points. And more importantly, if you look at the 5 years, that outperformance has been about 50 basis points, coming in at 5.7% versus 5.2%. On the next slide, just to look at where those returns have emanated from. Largest effect has been the selection effect, or the investment manager selection on the far right-hand side, delivering 80 basis points. A little bit of an offset associated with an allocation effect. And I think this is more to do with an overweight to private assets when we had such a strong rally in the Russell 3000, for example, in the fourth quarter.
So Steve, can I just interrupt? Because I know that there's going to be a question. So I'm just
Sure.
kind of trying to head this off at the pass. So on the allocation effect, is the allocation effect have anything to do with the current basket clause at 20? I'm sorry, the grandfathered in basket clause at 25%. And is there an anticipation that when we redo the asset allocation, given that the parameters have changed on the basket clause and it's moved up to 35, that would address the slightly negative allocation effect?
Yeah, the allocation effect, John, to answer that more specifically, has more to do with where we are relative to the benchmarks. And we had a little bit of the denominator impact last year, where public markets came down, the percentage allocated to privates actually went up on a percentage basis, but at a time when public markets had a very strong rally in the fourth quarter. So that was really what this reflects on for the fourth quarter results. To answer the question more broadly, though, given the constraints associated with the basket clause, we have been dealing with a constrained opportunity set, because we're capped at that 25% for those assets that fall into the basket. Moving that up to 35% gives the plan trustees, working again with the Bureau of Asset Management and the general consultant, an opportunity to reassess, capital market expectations relative to risk, relative to correlation. So as we go through that strategic review, and I don't want to presuppose anything, because the decisions ultimately reside with the Board of Trustees and the folks around the table or on the phone. But I think there's a likelihood, given the change in legislation, that there will be an increased potential allocation to some of those basket assets that will help performance over time. Does that answer the question? Are there any other?
Yeah, I actually have. To the extent it appears that there is a drag relative to the public markets in the very recent returns from private assets, as to what extent that is because of just the technical fact that valuations happen less frequently.
That's exactly right, Brian. Yeah.
Okay. So, but we don't have a reason to believe that substantively done worse in the last 3 months. It's just we don't have updated valuations.
That's exactly right. Yeah. So the public markets moved in price, and the valuations of privates haven't reflected that yet. So when the public markets outperform or had such the rally that they had in the fourth quarter, that would show that if we're over allocated relative to in privates relative to publics, that there's going to be a slight underperformance, and that's what this represents.
Yeah, and can I just add, this is just for a quarter. When you take a portfolio and you put more than 25% of it in liquid investments, you're always going to have some drag on, or it's not drag, drag's the wrong word.
Yeah.
Your variance to your policy when markets are moving. And we had both bond and stock sell off a lot last year. The long-term plan, and what you should hold on to, is that we believe we get either a higher return or a more diversified return from real estate, infrastructure, private equity, and even OFI And that over the long term, those will fit your plan in terms of trying to achieve your target return and lower or maintain a risk profile. And so I wouldn't overreact to this. I think it's pretty normal for your allocation index to be 20, 30, 40 basis points in a quarter like the fourth quarter, where one or two asset classes rally after a period like this when you have that much in private markets.
Yes.
The trade-off for putting money in private markets is completely in your favor. And so I wouldn't worry about this.
Yeah, I agree 100% with everything Doug just said, that's exactly the case. Again, anytime we go through our quarterly updates, we're forced to look at short-term returns, but we really should be thinking more about returns in the 5, the 7, to 10 year timeframes.
So Steve, if I could, based on what we read in the book for this month, and I understand everything that's being said here, we shouldn't knee-jerk react to a 3-month period, and we're hopefully in this for the next 200 years. It appeared to us that our manager selection outperformed by, I believe, 116 basis points. So if that's not the issue, why is the fire pension fund seem to be squarely in the 50th percentile when compared to like funds as for returns? Is it the allocation? Is it the basket clause?
Well, Liam, that's a great question. Let me answer the question this way. As a general matter, if you look at fire plans assets and other New York City retirement system assets that are subject to the same basket clause, they tend to have a lower allocation to private assets generally than your peer group. So I know that there's, for example, Texas teachers, they have an allocation to private assets. It's 54%. Now, I'm not advocating that we should be anywhere close to that. And those are decisions that board makes for that plan, separate and apart. But we're constrained because of the basket clause at around 25%. Again, it's now 35%. What actually goes into the basket differs and is subject to some level of interpretation, depending upon look through the underlying assets. But as a general matter, Liam, that's exactly right. It has more to do with the constrained opportunity set that had been 25% into those basket assets relative to peers and other market participants.
Can I just add, Suzanne? We had that conversation when the June numbers came out, and I said, look, your rankings are a little bit disappointing for the year and the 3-year. If you think about the last 4 or 5 years, we had this crazy run up in equities, public equities, and you were underweight public equities because we were trying to balance the portfolio better, differently with risk. And then when it comes to the peer rankings, because bonds sold off and stocks sold off, and you had a little bit more in bonds, say, than your peers because you had a little bit less in alternatives, and we had tried to make the equity ratio a little below peers because we don't want, to me, the equity ratio, the public equity ratio equates to, I think about the funding side. The volatility of your funded status has a pretty high correlation to your equity ratio. And that's why we try to spread that out. But if you think about some of your peers and because you're over 10 billion, the peer group is a smaller sample size for Tux. I don't know exact number right off the top of my head, but a lot of them have got 20% in private equity, and some of them have got 20 or 25% in private equity, 10%, 15% in real estate, and they've gotten into private credit heavy in the last couple of years. And there's a lot of them that are over 40% in illiquids. Some, as Steve said, up to 50 or even higher. They look great through, last year and even through last June, which is kind of a critical comparison period. But remember, we're going to see the flip side of private markets work through the numbers in the next 3 to 5 quarters. All the December numbers hit in March for private equity. So the big state pension plans that have 15 or 20% in private equity, depending on their managers and how quickly that cycle plays through, you're going to see some weakness in those numbers flow into March and June and September quarters. Now, this will work a little bit in your favor, even though we're trying to get a little more in private equity. We're still building our portfolio. We do have a mature portfolio, and I think it's well built. But I wouldn't the rankings, I know it sounds self-serving for me to say, don't worry about the 5-year rankings, but I think the goal here is not necessarily to manage to all your peers and do exactly what they're doing. The goal is to achieve your actual return and try to be in the top or the second quartile. So be a little bit better and have less risk than your peers. And we can show you that. We don't emphasize the risk numbers probably enough in these meetings. And we, Steve and I can work on those charts and kind of show you, we want to try to shade a little bit less risky to try to keep that funded status a little bit more stable. And that'll be the next conversation after private markets, they get marked. I won't say sell off, they get marked. There's going to be a lot of discussion about funded status and how that's changed for public pension funds in the last year or so, given the market performance.
Now, correct me if I'm wrong, the 5-year return had us under our 7%
It is.
discount rate.
Yep.
And so that obviously our biggest concern. I know that-
Absolutely.
Yeah.
Absolutely. And the last time we had a long period here where rates have been dropping, and with a quarter of our portfolio in bonds, we've now seen with the bond sell-off, a 10-year trailing return for bonds that's pretty flat, right? And so that's like ballast in a sense. We've been through that same cycle before with equities where we've had, a couple sell-offs and the 10-year return for equities have been zero. When you think about the portfolio and the asset allocation discussion will be about what's going forward. We've got higher bond yields in our favor. We've got equities that have started to reprice, maybe haven't finished. And then the private markets, they're going to reprice a little bit, but they're still a good long-term play for you. And that's being consistent. And again, the design should be risk that's slightly lower than your peers and get you that 7% return and have a ranking that's somewhere between 35th and 50th or something like that, over a 5-year cycle. So right now we aren't hitting that mark, but it's because of this transition that we're going through with the markets. There's a lot more things that we're going to discover besides Silicon Valley Bank in the next 12 months. I mean, it's the shadow banks are the next to kind of start to report things, right? They're the private lenders and some of the other managers in the marketplace that are their risks are going to start to show as rates really anchor in to longer term, and people are refinancing things that they have to refinance this year, next year, and the following.
So we're waiting for the other shoe to drop.
Well, I don't mean to be doom and gloom, but there are a lot of other things that are still going to play out here, and I think it's going to be a bumpy ride for the next 12 months.
So then,
This is Eddie
wanna
Brown.
stress-
Can I ask you a question? This is
Sure.
Eddie Brown. I read a lot of stuff about this Silicon Valley Bank, and we keep harping on the Ukraine and Russia. But then if we look at stuff that transpired in the last year with Sam Bankman-Fried, right? He's donating tons of money to politicians, and there's nobody watching the store. And then when you see Silicon Valley Bank, I have a thing here I saw the other day that there was no chief risk officer for months. The chief risk officer left in April of 22, and they did not hire anybody for another year. And then I read in the paper the other day that the person that was there, her main concern was not with chief risk, it was all ESG. Everything was ESG and donate money to this ESG and that, and nobody was watching the store. There's a quote from a guy here that says, it's like having an airplane without a pilot, says Charles Ellison, a retired professor of corporate governance of the University of Delaware. So now, the way the banks are all a mess right now, you have Janet Yellen basically saying, okay, we're going to cover that. So are the banks being nationalized on private businesses? Is the FDIC going to raise the number from 250 to 500,000? Because if I have 500,000 in the bank right now, I'm moving my money because it's 250. And Biden just vetoed the bill saying that pension funds about putting their money into ESG funds. He vetoed that bill. So what concerns me in this country is it seems like we keep harping on the Ukraine. China could attack Taiwan tomorrow, but it seems like we don't have our own banks and financial system in check right now. Am I wrong there?
There's a lot to unpack there, Eddie, but I think you're right. I think there were some regulatory misses associated with the Silicon Valley Bank in particular, and perhaps Signature Bank as well. I think that was acknowledged by both Fed Chair Powell yesterday, as well as U.S. Treasury Secretary Yellen. I think there will be a review, and I think that's probably necessary to take a look at that. In terms of deposits, I don't think that there's a necessarily a systemic issue, although the regional banks tend to have been less, had lower capital requirements and perhaps less regulatory scrutiny, which I think the regulators are going to take a hard look at, as well as the legislators, to be candid, in terms of what's required there. You could make an argument that perhaps the 250,000 insured deposit base is a low number and it should be something higher than that. But I think that really, those decisions ultimately will rest with the legislator and not necessarily the regulator. So I don't think that the banks are going to be nationalized. I agree with the comment earlier. We're not out of the woods yet. I do think that these things break, they take time. And the fact that the markets may be rallying today and feel a little bit better, it's not to say that there won't be more concerns down the road. So now's not a time to be cavalier around risk again, but I do think as a long-term investor focused on long-term outcomes, you're fairly well positioned.
But if the federal government is saying that they're going to back the banks, isn't that a form of nationalizing the banks?
Well, I don't think they've actually come out and said that they're going to back the banks. I think that was a question that U.S. Treasury Secretary Yellen was asked yesterday by legislators, and she came out and said, no, we're not looking at doing anything to increase the FDIC insurance at this point.
I was watching CNBC this morning before this meeting, and they had a conversation about if they're backing the banks, it's basically a form of nationalizing the banks. We're not going to call it that. But if that money's guaranteed over $250,000, listen, when you got people in Silicon Valley lined up, we have Twitter today, and there could be a run on the banks in a minute with Twitter. It's not 1973. Right now, people see something goes wrong on Twitter, and you'll have people lining up on the banks.
Yeah, this is Doug. I think the comments that Janet Yellen made were designed to try to reassure the average person. I don't feel like they're moving to nationalize the banks, but they are worried about sentiment. And the reality is the average 99% of us are protected by that FDIC guarantee, and then also by private. Some of the mutual banks have private additional insurance on top of that. Silicon Valley Bank is a very
99% of the pension funds, forget about the firemen in the Bronx with $10,000 in the bank. How about the pension funds if they have money in all these different places?
Yeah, most pension funds, if they're going to invest in their cash, they're going to use a money market fund, which is separate from the Fed's, from each bank's balance sheet. So they're more like a mutual fund. They're their own entity. They're not subject to a run, although they are sometimes subject to pricing risk from the securities they own. So that's a big difference between having an account at a bank where it's really part of the balance sheet or a CD. Yeah. And Silicon Valley Bank was a very unique bank in terms of its customer base being concentrated. The fact that they have grown very significantly in the last 2.5 years. They were investing a lot of their capital in the treasury market and the mortgage market. So they weren't out making mom and pop loans to small businesses. They did have some credit lines that they ran for, again, that same concentrated customer base. And they had a high percentage of their assets that were kind of classified in that hold to maturity. So there were a bunch of things there that were very unique and not similar to the average bank that we put our money in or have our checking accounts with.
And they also didn't risk manage the duration exposure properly. It was a classic asset liability duration mismatch. They had unstable funding on the short end, and they took undue amounts of duration risk by investing in long treasuries.
Right, they were making $1 billion a year. They were making $1 billion a year, but when the interest rates went up, they were done.
Yeah, yeah. I think that's been a challenge for a lot of the banks. And I think that's an issue where there's some residual concerns from a stock price perspective in regional banks. It's more of an earnings story right now than a liquidity issue for those banks. They've basically have access to enough liquidity based on the Fed, the new facility the Fed put in place with the Treasury and the FDIC. But yeah, more to come on this. Just so you know, if I can answer the question directly, I think Doug touched on any money market balances that the pension plan has, the fire pension plan has, is very, very conservatively managed. We've had zero exposure to Credit Suisse since I've joined. We had no exposure to Silicon Valley Bank or Signature Bank from a deposit standpoint. We typically buy money center bank CDs and mostly U.S. Treasury short T-bills. You have a zero allocation of cash, so any of the monies we own, we typically invest for 2 weeks to a month. Really that's just to meet benefit payments and private market capital calls. It's more.
But if you talk about Credit Suisse, that was a very, very well-respected bank. Am I right?
They've been in trouble for 10 years.
Right.
So-
how many compliance
so-
issues have they had through the years?
So,
Many.
so guys, I recognize now we're kind of drifting into a broader conversation, which I actually.
I'm sorry,
very
we'll get
important
off this.
conversation. But I'm also mindful that there are time commitments this afternoon relating to members of the department and fallen members of the department. So I'm very mindful of that.
Let's move
so-
on, John.
Yeah, so with that said, Steve, if you wouldn't mind, I believe there's one more question in the room and then giving your final remarks on the quarterly, and then we can
Sure.
executive.
So,
Will do, John. Thanks.
basically to sum this up for us to, the table anyway, to fully understand. We've known what our parameters were for the basket clause for a long time. And I understand that those parameters limit us, but we've known those rules. And we are one of the more underfunded pension funds of the five through unfortunate circumstances. So knowing what the rules were, knowing that we've trailed the 7% that we need to hit, what do we need to do going forward to try and make sure not only hitting it, but obviously surpassing it in order to get us back to where we need to be?
Well, I think, Liam, looking at just 5-year returns is probably even a little short for the pension plan. Your point's well taken, though. You came in, 100 or 200 basis points below that 7% target. I think if I'm reading the question correctly, it really underscores the importance of the work that the trustees need to do and the decisions that they have around asset allocation. So as we go through this process of reevaluating asset allocation with Doug and his team, in light of the change to the legislation and the increase in the allocation of basket eligible assets, I do think that we really need to be very thoughtful, and we hope and plan to be very communicative through this whole process and give the trustees monthly updates in terms of where we are. And make sure that the decision, when it comes time to make those decisions, that the trustees have all the relevant information that they need to make a prudent and sound investment decision.
Steve, I appreciate all the information, and I do not take lightly the fact that we're not trying to basically invest in real estate off the coast of Miami that doesn't really exist in regards to risk. I get that. So I'm looking forward to the conversation. I think the asset allocation, and I think John Dorsa will agree that we need to really put a fire into getting our IPS together. And I am all in regards to the amount of time and when we need to get it done, I'm available.
Terrific. Great. Thank you, Liam.
So with that said, Steve, you want to offer some final remarks before we head into executive session?
Yeah, maybe just one or two slides forward, Kate. If you move to the slide on private market excess returns. Now, we've already caveated this by saying that the returns tend to lag. They may not be marked on the upside as to the same extent as public markets, or the downside for that matter. But if you look at the 1-year excess returns here in basis points relative to the benchmarks that are to the middle left of the page, you can see that there's been significant outperformance in hedge funds, private equity of over 2,000 basis points or 20%. In core and core real estate, I should say, in 1 year, non-core is actually underperformed because it tends to be riskier, more opportunistic and value-added strategies. And in a risk-off environment that we saw in 2022, that's reflected in that underperformance. But infrastructure and opportunistic fixed income have also generated significant excess returns. So, you have to look at these and understand the fact that they may not, you can't count on these returns, but there has been outperformance, and these have been good performance drivers for your portfolio over the longer term. So again, I'd encourage you to look out to the far right-hand side, where the 10-year excess returns are probably more worth noting. And again, they're significant as well and positive across the board. With that, there's nothing else really to talk about. You've had a little bit of rebalancing just to raise cash to meet capital calls and benefit payments, and the portfolio allocations have been well in line with targets and expectations throughout the quarter.
So thank you, Steve. And I just want to note, we'll be doing a risk presentation at the next meeting. And a lot of the questions that were raised about bank stress tests and other things, I think would be appropriate at that conversation when we have the chief risk officer here to address risk in general.
Yeah, I think honestly, I think the only question that we asked in regards to the banks and what our exposure is were, I think Credit Suisse was the only one that we were waiting on the particulars for. We know what it was to Signature, we know what it was to Silicon.
But this is just, I'm making more of a blanket statement on
And then
broader impact.
due to time, I appreciate it. And just, I know we're under some time constraints. I can hold off on the questions that I have here regarding this month's book for next month.
We'll
Liam, I can also just say, we obviously look at all these exposures. I had on my desk all the exposures to Credit Suisse, which were de minimis, minimal, mostly in bonds that were not, maybe the spreads are wide now, but the default, they didn't default. So the position is tiny. We didn't think it was so de minimis, we didn't think it warranted sending out a BAMogram to the trustees, but we have that information. We'd be happy to share that with you. And from a cash credit perspective, where your short-term assets are invested for liquidity, you had zero exposure to Credit Suisse.
Thanks, Steve.
Sure.
All right. So with that said, and I'll encourage anybody to reach out to Steve at any point. Wait for him to get back from vacation, but
No, you can reach out to me now.
About the portfolio, please feel free to reach out between meetings. With that said, I would like to make a motion that we exit public session and enter executive session to discuss specific investments.
Second.
Any opposed? Hearing none, the motion carries. We are now in executive session. Please turn off the camera.
All right, Bam.
Any opposed? Hearing none, the motion carries. So are we? Yes, okay. So we need a motion to move into the public session, close this meeting and start the FFVS meeting.
So moved, John Dorsey. Recording. Great.
Okay, any opposed? Hearing none, the motion carries. So now we have begun the FFVSF meeting. Mr. Dunn, would you please start the roll?
Okay, roll call for firefighters VSF. For the Mayor Adams,
Brian Berge from Mayor Adams.
Controller Lander's office, and Commissioner of Finance Nyblock.
Sit in the back row.
Okay, and for the UFA, Mr. Eustace
Present.
and Mr. Brown.
Present.
Okay, we have a quorum.
The board is requested to note the receipt of the quarterly reports.
So noted. And with that, we would make a motion that we exit the firefighters variable supplement fund.
Second.
Okay, and now I'd like to make a motion that we enter into the fire officers variable supplement fund.
Second.
Right, any opposed? Hearing none, the motion carries. Mr. Dunn, would you please start the roll?
Certainly. For Mayor Adams,
Brian Berge for Mayor Adams.
Controller Lander. Commissioner of Finance Nybon,
Kevin Lear.
and for the UFOA, Mr. Christopher Jensen.
Here.
And Mr. Liam Guilfoyle.
Here.
We have a quorum.
The board is requested to note the receipt of the
So noted.
So with that, I'd like to make a motion that we exit the fire officers variable supplement fund and enter the public session of the fire pension fund.
Second.
Any opposed? Hearing none, the motion carries. We are back. Pension fund meeting. During the executive session, the board discussed various investment matters. We now need a motion to adjourn.
So moved, John Dorsett.
Second. Liam Guilfoyle.
Any opposed? Hearing none, the motion carries. The meeting is adjourned.
Great.